So Jamie Dimon, the head of JP Morgan Chase, says he isn't worried about private credit. But then, in the same breath, he starts talking about spotting cockroaches in the financial system. Okay, we need to talk about this. Because when the undisputed king of Wall Street starts using language like that, it's probably a good time to pay very close attention to a part of the market that has quietly become absolutely massive. And there it is, right from the horse's mouth. Now, this isn't just him using a colorful metaphor. When a guy with his view of the world uses a word like cockroach, he's sending up a flare. He's saying, hey, what you see on the surface, that's not the real problem. The real rot is hidden.
So what does he actually mean by that? Well, in finance, the cockroach theory is this old Wall Street saying, and it's pretty simple. When you see one piece of bad news pop up out of nowhere, like a company suddenly defaulting, it's almost never just one isolated thing. It's usually the first one you see scurrying out from a much bigger hidden infestation. Where there's one, you can bet there are many, many more.
So this all leads us to the central debate, right? Is Dimon's warning a real canary in the coal mine, a genuine early signal of some serious danger ahead, or is he just another market chicken little running around screaming that the sky is falling? And that distinction is absolutely critical. A canary warns you about real data-backed danger. Chicken Little just panics. To figure out which one we're actually dealing with here, we have to ignore all the noise in the headlines and just follow the data. So, where are all these potential cockroaches hiding? Well, they're in the private credit market. And to really get a handle on the risk, first you have to appreciate the sheer scale of this industry. The private credit market has absolutely exploded. We're talking $1.8 trillion. To put that into perspective for you, that is larger than the entire U.S. high-yield bond market. We are not talking about some small niche pond anymore. This is an ocean. So what is this stuff exactly? Well, private credit is basically shadow banking. It's all the lending that happens outside of the normal, highly regulated banking system. You see, after the 2008 financial crisis, banks got slapped with way stricter rules. So this whole new universe of non-bank lenders popped up to fill the void, lending money to companies that the big banks might now consider too risky. This is exactly where that shadow banking bubble has been inflating, quietly, for years. All right, now let's follow that data trail. Because when you actually start to dig in, you find this enormous gap between the official story that everyone's hearing and the reality that's bubbling up underneath. This is where we start to see the first real signs of trouble. Just take a look at this. The industry's own surveys are reporting this comfortably low default rate, right around 2.2%. Sounds fine. But then you look at independent data from a place like Fitch Ratings, and they're telling a completely different story. They're seeing default rates hitting a record 9.2%. That isn't just a small disagreement. That's a massive gap between the official story and reality. And there it is. That's our first cockroach. This gigantic discrepancy in the data, it's a huge red flag. It suggests that the risk in this market is being systematically underreported, and the true health of all these loans is probably far, far worse than investors are being led to believe. The second problem is liquidity. These investments are sold as if you can get your money out whenever you want, but when investors actually try, they're hitting a brick wall. In just the first quarter of this year, BlackRock had to block a huge number of withdrawal requests. Morgan Stanley, they only managed to fulfill about 45% of theirs. And then you have Blue Owl Capital, which just permanently froze redemptions on one of its big funds. This is our second cockroach, the locked exit. It's what people in the industry call a liquidity mirage. The ability to sell and get your cash back looks totally real from a distance, but when you actually reach out and try to touch it, it just vanishes. The money is trapped, mainly because there's no real secondary market to go and sell these private loans. Okay, so what happens when one of these loans actually does go belly up? It gets even worse. According to the Federal Reserve's own data, when a traditional syndicated loan defaults, the lenders usually get back about 52 cents on the dollar. But with these private direct loans, the recovery is only 33 cents. And why is that? Because often they don't have hard, tangible collateral, things like property or equipment that actually back the loan. So what do you get when you combine fuzzy data, locked exits, and really poor recovery rates? Well, these stop being isolated little issues. In a market this huge, they start to create serious stress across the entire system. And this brings us to the crucial difference between non-systemic and systemic risk. Non-systemic risk is when one company fails and the market basically just shrugs it off. The problem is contained. Systemic risk, Well, that's what we saw in 2008. That's when one failure, like Lehman Brothers, kicks off a domino effect that threatens to bring down the whole market. It's like a financial contagion.
And this leads us to the critical multi-trillion-dollar question. Given the enormous size of this private credit market and the cracks we're now clearly starting to see, which kind of risk are we actually facing? Is this a contained problem, or could this be the beginning of something much, much bigger? Now, you might be sitting there thinking, okay, this sounds like a problem for giant Wall Street institutions. But here's the brutal truth. This very risk has already found its way into Main Street investment portfolios, and it's often completely undetected. Take a look inside a typical high-yield fund that's marketed to regular retail investors. You might think you're buying a mix of bonds and stocks, but look at that huge slice of the pie, often 40% or even more, is actually allocated to this exact type of junior, illiquid, and really risky private debt. And the most shocking part? It's estimated that 90% of the investors in these funds have absolutely no idea.
So, how can you check your own portfolio? Here's a quick 3-step stress test. First, look at your fund's list of holdings for BDCs, which stands for business development companies. They're a very common way this stuff is packaged. Second, look for the term PIK, or payment in kind interest. This is a massive, massive red flag. It means that the borrowers are so stretched, they're paying their interest with more debt instead of actual cash. It creates this dangerous debt spiral. And finally, ask yourself a very simple question. Could I sell 100% of my position tomorrow if I had to? If the answer is anything but a confident yes, you have a liquidity problem.
And this really just leaves us with one final thought. You've got people like Jamie Dimon shining a flashlight into the darkest corners of a financial system, and they're starting to point out the cockroaches. Now that you know what they look like, the real question is, how many are hiding in your own walls?